Welcome everybody to December. I'm Mike Carrazzo, joined always by Nick Webb for Cup of Joe. Nick, what's going on?
Mike, how you doing today? I'm great over here. We got a sunny day here in Chicago in December. Can't ask for much more.
I know, yeah, it's unseasonably mild. I think it's going to be in the 50s this weekend, which is pretty good for December. So
amazing.
Can't complain at all. This is our last Cup of Joe for the year, and it seems like it's just gone by. And actually, it is. Did you know it's our 24th episode of Cup of Joe? Would you have guessed that?
Time flies when you're having fun.
Yeah, it's 2 years, right? If my math is correct.
Sounds about right.
Yeah. It started right after our virtual conference Engage, which we hosted 2 years ago. That was I think we did a commodities update there. And people loved it. So we decided to bring you back on a monthly basis. And here we are 2 years later, still doing it to this day. So would you ever think it would last that long?
Yeah, we would have started it a whole lot earlier, but I think the powers that be were a little afraid to let me go live unleashed. So I got a little bit of media training, learned what the appropriate way to approach something like this is, and we were good to go.
Yeah. You've gotten tamer and tamer as it's gone. No one's afraid of what you're going to say anymore. No, it's been a blast. And the reason I mentioned all this is we have Engage 2024 coming up. That's going to be on February 1st. And we're going to drop the registration link here in the comments. Ironically, that's the first Thursday of February. So we're going to do our show as scheduled January, the first Thursday in January, which might be the 3rd or 4th, if I'm not mistaken. So we'll be live. But then there's going to be no Cup of Joe live in February. Instead, we're going to have Engage conference. You see here on the screen, 10:30 to 1. Don't worry, it's not 3 hours of Nick Webb. It's going to be Nick. Yes, we're going to have Alan Bolio. Sorry,
like polio.
Thank you. Sorry, Alan. He will join us for the 3rd year now in a row. We're going to have some AI experts talking about manufacturing. We're going to release some custom data that we're putting together. So it should be a good show. So I wanted to make sure everyone's aware of that. Registration's open. So yeah, join us. It's going to be a lot of fun. Speaking of fun, as the last episode of the year, we thought we'd do something fun today. Nick's going to go through the general updates, macro, and into the metals, and then we're going to play a little game of Stump the Expert. So the audience are really good at asking questions. Ask away, even if it's about the market, but maybe try to throw in a question or two there that'll stump Nick. But not to just isolate on Nick. We thought we'd bring in 2 more experts to join us. Mark Gross, who is our Assistant Director of Supply Chain. Hi, Mark.
Hey, Mike.
I think this is maybe your 3rd episode of Cup of Joe, if I'm not mistaken.
I lose track over time.
Yeah. And Jeff Notice is our Director of Supply Chain, and I think this is your 2nd.
This is my 2nd. Yep.
Okay. You get the green jacket.
It's 50 degrees in Minnesota, so
amazing. 50 degrees in Minnesota.
Yeah.
It's like summer.
It is. Yes.
Well, Jeff and Mark, experts in our metals, they're going to chime in during the metal section of this, but we'll bring them all 3 of them back at the end for this Stump the Expert. So let's have a little fun with it. So without further ado, Nick, why don't you take it away?
Yeah, absolutely. And for Jeff and Mark, for anybody on the audience who have specific questions on, carbon, what we're seeing with the mills in carbon, or on the aluminum side, Jeff and Mark are going to be excellent additions with regards to the intel that they can bring to that side of things, which is something that I normally don't cover. So keep that in mind as you're thinking about questions to potentially ask while we're covering the metal section. Also, I am pretty excited to hear Alan Bolio's presentation next month, because it will be interesting to see how his information either compares or contrasts to what we're going to cover here in the macro update, which I'll start with here in a couple slides. Could be interesting. Hopefully we get some varying opinions. Hopefully it's not the exact same thing you've already heard, and I think you will get some pretty interesting takes relative to what you normally hear from my side.
Like it. It's been a nice balance, right? You have Alan from this really broad perspective, which you touch on as well, but then you really kind of hone in on the metals. So you're going to get a whole well-rounded look at the economy and metals in general, I think.
Yeah, for sure. Before we hop into that, we have to cover the safe harbor provision. These are the opinions of Nick Webb, Mark Gross, Jeff Notice, Mike Carrazzo. They are not the opinions of Ryerson. Do your own research. We're going to have some fun today, and we're going to get you some good information, but got to cover the legal aspects. First things first, getting into PMIs, as we oftentimes do. It's really kind of a boring story at the moment because it is kind of a continuation of the same. For the most part, most regions of the world, or at least the parts of the world that we're most interested in, North America, bit of China with regards to commodities, they're all kind of hovering either side of 50 with regards to the manufacturing PMIs, which is kind of flattish growth. Some of these regions are a little soft, as has been the case for about 6 or 7 months. Europe continues to slog along, trough along. Very much so looks like recessionary conditions in most parts of their economy. And then as we've seen for the better part of a year at this point, both India and Russia, at least per the PMI data, are showing fairly strong PMIs. So pretty interesting, the growth coming out of those areas, given all the geopolitical things that have been going on. But for the United States, I would say it's marginal slowness is really the name of the game with regards to the manufacturing scene. So just a little bit of softness on the PMIs. Now, actually, Mike, I'm going to kick it back over to you to give a little background on what this is.
Yeah. So this is a little teaser to the custom data that I mentioned at the top of the hour for Engage. We did what we call the metal perspective, which is we survey our customers on everything from the state of U.S. manufacturing to looking ahead for metal purchases, implications on fabrication, things of that nature. And we just wrapped up our results, which will be published here in the coming weeks. And we're going to talk a little bit about that in Engage. And actually, we'll dive into some more of the results, I believe, in the next episode of Cup of Joe. But we thought this might be a really interesting one because you're about to get into some of the inflationary trends. And we asked specifically how recent inflationary trends how are they impacting your metal purchases? And, I don't know if it's surprising or not. Nick, you tell me. 40% say it really hasn't had any impact. Whereas the significantly to slightly increased just at about 10, collectively, 13. And then you've got we'll call it 33 to 35% saying that it's impacted decisions, decrease their purchasing decisions, so that they're purchasing less. But it seems like for the majority, it's not really having an impact. Would love to gauge what you think of that, Nick. Does that kind of jive with what you're seeing?
As I'm thinking about the last 2-3 years when we did see this massive inflationary cycle, I will say that business conditions over much of that time period were so strong that it really did seem like customers were willing to pay most any price that was out there, whether it be for a commodity good or for the finished goods. Money was out there, money was being printed, and people were feeling pretty good. And I think a lot of that just was getting passed through. So I sort of understand that a little bit. I think when we look at the next biggest answer, the 35% of slightly decreased, I think that makes sense. When that's what I would have expected, that as prices go up and up and up, you would expect at some point it begins to bite. And I think we are beginning to see some of that bite. And I would also argue that we're getting into conditions now that as inflation is coming back down, some of that's due to the fact that people are buying a little less. So it is kind of a self-fulfilling prophecy a little bit. And I don't want to brag too much for our marketing team on this, but I had a sneak peek to look at some of the other questions and answers that were given. It's really good information. And what's really impressive about it is, and correct me if I'm wrong, Mike, it was around 1,000 respondents that we got answers from. So, you think about some of the other manufacturing surveys that are out there. This is one that's becoming a pretty good barometer, at least for the metals perspective it's called the metal perspective, for the metals perspective of the manufacturing side of things. So it's a pretty cool thing to kind of be I don't want to say we're the arbiter of truth within the metals industry, but this is certainly a good broad swath of the industry.
I appreciate that, and I think you're right. The insights we're getting, we asked everything from how are you what's the state of manufacturing right now, and what are things, how's onshoring and supply chain disruptions. So yeah, as we get further into the results, I look forward to kind of digesting those with you, Nick, because I think there's some pretty interesting stuff here.
Yeah, looking forward to it, and anything I can do to try and get you a Christmas bonus as well.
Thank you. Thank you.
With that being said, as we're on the topic of inflation, there is some fairly encouraging signs that are going on in the inflationary trends. This is showing the headline CPI, which is going to be the blue line at 4%. And then I apologize, headline CPI is going to be the white line at 3.2. Core CPI is going to be at 4%. Again, the main differentiator between those two is core inflation would exclude food and energy. So as you may expect, with energy prices having come down pretty substantially in the last couple months, we are seeing the headline number actually exceed to the downside the core number, which does not include that energy component. But that being said, both of them are generally trending the same direction. We're still above the Fed's goal of 2%, but we are creeping that way as we sit here today. Now, I do want to spend a little bit of time on the energy side of things, because if I was going to back off my personal recession calls for 2024, the one place where I would say a soft landing, this proverbial soft landing of not having an official recession, but having a little bit of a slowdown in the economy and inflation just naturally comes down, that's kind of the idea of a soft landing. The energy picture is the one that I would say would allow me to potentially arrive at the soft landing conclusion. And I'll explain why here in the next couple slides. As you can see, over the last roughly month and a half, the price of crude oil has come down by 26%. So fairly meaningful move lower in crude oil. That's going to impact things like gasoline, diesel fuel. It'll have knock-on effects to all of these transportation items. Now, what's causing it? You may have seen in the headlines over the last couple of weeks that OPEC was announcing supply and production cuts, and they have done that. The blue line is going to be showing the OPEC production numbers. It'll be on the left axis, so it's currently right around 28 million barrels per day. In the white line, however, and this one I feel like is less reported on, U.S. energy production, oil production, has actually jumped by about 1.8 million barrels per day. So there's a situation where almost everything to which the OPEC group, the OPEC cartel, cut oil production, the U.S. has kind of ramped up over that same time period. So you kind of have this alligator mouth situation. So net, globally, we really haven't had a reduction in oil supply. So I guess my point on this is the fact that we've seen oil prices fall over the last 2 months by about 26%. I don't think that's a phenomenon of weakening demand. In fact, I think demand is holding up pretty darn well across the globe for things like jet fuel, diesel fuel, oil in general. I think the phenomenon of oil prices coming down is more so due to the fact that the U.S. has basically gobbled up market share from some of the other big oil producing regions like OPEC, and has successfully brought down prices up to this point. So that would be a scenario where demand isn't the issue causing prices to come down. It's actually supply, which could cause inflation to come down without actually, destroying the economy, which would be the recessionary impact. Now, it is worth noting a lot of that oil, a lot of that energy that's come out in the last couple of years, that has come from the Strategic Petroleum Reserve. And up to this point, it really hasn't been replenished. Only very, very slightly. You can see down in the bottom right corner, has the oil been repurchased and put back into that Strategic Petroleum Reserve. If that is to happen, if the Department of Energy does go out and starts bidding up a lot of these energy contracts to refill those stockpiles, that could change the picture a little bit, and it would add an incremental bid or an incremental buyer in the market that could cause prices to prop back up. But this will be something we want to keep an eye on as well. Now, as we think about inflation and how the Fed is going to be approaching it, if you look just down at the bottom chart, that is basically the expectations as we look into 2024 and 2025 of where the market and analysts and traders, where they think interest rates are going to be per the Federal Reserve Fed funds rate. And as you can see, for the next couple of months, the expectation is they're done. The expectation is they've done enough to cool down the economy, cool down inflation, and as soon as potentially March of 2024, the expectation is they may begin cutting. Now, this is where I may deviate a little bit from some of these market participants, where I'm more of the opinion that the Fed likely, in my opinion, isn't going to cut interest rates unless things get bad and they have to. But there are some who think that if inflation goes to 2% or perhaps even lower than 2%, the Fed will say, we've done our job, we can start cutting interest rates. and maybe they do begin to cut things down. And that would be your scenario of a soft landing where you don't actually get a recession. Fed begins to cut rates and kind of loosens up on its grips on the economy. But those are just differences of opinion. Now, a couple things with regards to this expectation that the Fed is going to be cutting rates. One thing that happened is in the last, let's say, 2 months or so, the 10-year Treasury yield, along with pretty much every other Treasury yield, has dropped back down from fairly high levels versus what we've seen over the last couple of years. This is looking at the 10-year Treasury, which is down 80 basis points just in the last 2 months, which that's a very meaningful move in terms of its accommodativeness to the economy, or its loosening of its grips on the economy. So a little bit of good news there. What I would say is it's certainly feeding into good news in the stock market. This is looking at the S&P 500, which in the month of November, and again, I'm kind of highlighting this fact that all of these things have kind of happened at the exact same time. Energy prices coming down, the yields coming down, stock market rallying. So the stock market actually had, I think it was its top 4 best months in the month of November in the history of the stock market. So stocks certainly are watching interest rates as a function of whether or not they should be bullish or bearish. And right now, it's very much so in the bull camp. And this one, I say a little tongue in cheek, but there are probably people on this call who are holding cryptocurrencies. This is the price of Bitcoin over the same time period. Bitcoin jumped by 64% over that same time period. So as market participants are thinking that, hey, the Fed's done, interest rates are going to start coming down, a lot of money's piling back into risk assets. And some of these assets are a little more risky than others. I would argue that Bitcoin is probably a bit more risky than the S&P 500. But that's, I guess, for the betterment of people feeling good, that these are all very good things. Interest rates coming down, people feeling like they can buy a home, asset prices going up. There is somebody who doesn't like this, though, and that would be the Federal Reserve. This chart is looking at financial conditions. Basically, this is a fancy way of saying how good or bad are people feeling about the economy. When this chart is very high, it means that there's a tightening effect to people's ability to spend money. So that would be things like the stock market going down, interest rates going up, the dollar getting weaker. That would be when things are high. When things are coming back down, as we've seen in the last couple of months, that would suggest that people are beginning to feel a little more wealthy. People feel like they might be able to spend a little bit more. And certainly the crypto guys are out in full force right now talking about how bullish they are on cryptocurrencies going to all-time highs. That's all well and good for them, but for somebody like Jay Powell, who's trying to calm down inflation, calm down spending, this is something that could be a thorn in his side, and maybe perhaps a suggestion that he's going to keep rates higher for longer. We'll have to see. But this is certainly something I'm sure Jay Powell's watching, because this could be inflationary again if people start feeling really, really optimistic about things.
Saying as people get a little bit more optimistic, maybe take on a little bit more risk, that spikes something like cryptocurrency. They're more, I guess, they want to invest it in more. Is that right?
Yeah, I'd say that's the case. Yeah.
Okay, because the economics around them are a little bit less than risk, right? Okay.
Yeah, for sure. I mean, you take like the 10-year Treasury, if that's gone down by 80 basis points, that in effect basically means that your cost to get a 10-year mortgage for a home, or perhaps a 30-year mortgage for a home, has come down by a similar amount. So it does make people feel a little bit more willing to go out and make big purchases.
Do you think crypto is influencing the Fed cuts or Fed rates more than maybe people ever expected?
It feels like it's a niche part of the economy, but I do feel like there are some fairly large players and wealthy players who do participate in that market. And there are meaningful dollars that have been made and lost in that world.
Yeah.
I don't know exactly, whether that's feeding through to people's willingness to drive overall inflation, but it's certainly a factor. Pull out cryptocurrencies and swap in gold. Gold prices too just went to all-time highs just in the last couple of weeks. So there is some inflation across a lot of different types of assets that's occurred.
Yeah, interesting.
Now, one of the main reasons why I have a little bit of a difficulty with this soft landing narrative or this idea that the Fed is just going to naturally take interest rates down, is typically, looking at history, this is going all the way back to the 1970s, the Fed typically is not cutting interest rates unless recession risks are high. And you can kind of see that with the vertical red lines over history. Usually when there's a hiking cycle and then eventually a turning lower in interest rates, this is the Fed funds interest rate. Usually that's not taking place until or unless you're kind of heading into a recessionary condition. So I don't know whether this means, the recession risk is going to happen or show its ugly head in Q1 or Q3. But this idea, in my opinion, that Jay Powell's just going to say, yep, I've done my job. Inflation's at 2%. I can go rest now and take interest rates down by 200 basis points. My concern with him doing that, or I would guess his concern with doing that, is if you all of a sudden start cutting interest rates without inflation really coming down or without the economy really cooling, you could get a second wave of inflation, which we'll see if that takes place. And then lastly, this is probably the bigger one that I'm keeping an eye on with regards to potential recession risks. This is the U3 unemployment rate. We talked about it last month, but this data is going all the way back to the 1940s. And again, history just isn't really on our side, that when this unemployment rate starts to move higher, it typically doesn't just stop. It doesn't move higher by 0.5% and then just stop. It tends to be a very momentous thing. And as that becomes more momentous, at least over history, that has led to a resulting inflation. So it's not to say that it can't happen. I'm just saying that looking back over the last 60 or 70 years, the probabilities are not exactly on our side as we sit here at 3.9%. But that being said, tomorrow we will get the new unemployment rate. So there are going to be a lot of eyes watching that. If it ticks above 4%, you're going to have a lot of people saying, uh-oh, this is getting a little more cautionary. But we'll have to wait and see how the data comes in the coming months. My analysts and I had a chance to listen in. This is just a quick aside, a little bit of different information. We had a chance to listen in. It was an MSCI event. They had this economics team called Keybridge present their take on the economy. And I found a couple of their slides to be pretty interesting. This one in particular is kind of calling out the let's say the bad job that economists did in forecasting a recession in 2023, because as we all know, we didn't in fact have a recession. There were many out there saying that they thought we would. I would say potentially myself included. And his argument for why that didn't take place and why that hasn't taken place yet is because of this, what they call fiscal impulse, which is basically government spending, basically governments sending checks into the economy. They estimate that about $4,000 per household over the course of 2022 and 2023 went into the economy. And that was in the form of employee retention credits, transfers, basically large-scale transfers to state governments, and then daycare subsidies. So those things may not sound like a whole lot, but I think this chart does a really good job of showing how these government spending programs fed into the economy over time. I found this chart to be really fascinating, and I think even a good explainer of why we saw such rampant inflation that we saw. The top blue line is real disposable income. So real basically being teasing out for inflation. The purple line is going to be basically spending, expenditures. And you can see that from 2017 to 2020, the two of those tracked along perfectly fine, very, very strongly correlated, and that makes sense. You usually don't want to spend more than what you're making unless you're feeling like you're going to get a raise or a bonus or something like that. Usually people spend within their means, and that's incomes. So that relationship makes a whole lot of sense. Well, what happened in 2020 was a couple things. Obviously, we got lockdowns. People weren't spending a whole lot of money because they were not leaving their homes. They were scared to go out. They were told not to go out. So you can see the dramatic declines in spending, which meant that you all of a sudden had a whole lot more disposable income. In addition to that, there were $1,200 checks sent out. There were $600 checks sent out. There were $1,400 checks sent out. And all of these things, all they did was widen that gap between disposable income, or in other words, dry powder to buy airplane tickets, Taylor Swift tickets, go out to dinner, whatever it may be. And I would argue that absolutely had an impact on feeding into higher and higher prices and inflation. As we roll into 2022, 2023, we've seen a little bit of this phenomenon reverse, whereby Incomes are beginning to trace back a little bit below trend, and spending is kind of right around, if maybe slightly below trend as well. But this gap between incomes and what they're spending money on is certainly tightening, and that's a bit of a concern, because it means that people may be dipping into savings more. People may be putting more money on their credit cards, and those are things that are a little bit, in my opinion, to be late cycle economy type phenomenons. And with that, this is a different way of looking at some of the GDP data that we've looked at in the past. This is looking at gross domestic product. So that is the total country's basically money spent on products. The blue line is going to be gross domestic income. Now, in economics, they're basically supposed to be kind of the same thing, because again, income and what you spend money on should be roughly the same. What we're seeing right now is fairly interesting, where just if you look over on the very far right-hand side, gross domestic income, which again is the total summation of everybody's incomes in the United States, it's actually now ticking negative on a year-over-year basis. It's not by much, but it is negative 0.2. If we compare that to where GDP is right now, which GDP oftentimes gets more of the headlines, GDP numbers at 3%. So there's this very large gap right now between where gross domestic product is and where incomes are trending. And the best explanation that I've seen up to this point is that could very well mean that people are either dipping into savings or putting money on credit cards to get the economic outcome that we're currently seeing. So this is a bit of a warning sign that we may begin to see GDP numbers tick lower and perhaps even tick negative. And for those keeping score at home, the technical definition of a recession would be 2 consecutive quarters of negative GDP growth. So that would be the instance that we would need to see happen in order to get one of these red vertical lines of recession. But it is worth noting that already we are seeing GDI, which is gross domestic income, down into that recessionary risky zone. So something to keep an eye on as well. Oh, and the other thing I would say is this spread, an analyst I follow, they track this all the way back to the 1940s. The spread between GDI and GDP is actually the widest it's ever been, going all the way back to the 1940s. So something peculiar is going on for sure. Now, with that said, let's go ahead and hop into the metals. And what I will encourage Mark and Jeff, if you've got anything you want to add from the mill perspective on any of these charts, or if you have additive information you want to touch on, feel free to chime in at any point in time. But as we always do, this is looking at the U.S. hot rolled coil price relative to European in blue and Chinese pricing in orange. And really, for the last couple of months, both Europe and China have been fairly subdued and pretty downtrodden with regards to their price levels, down at 505 and 650. U.S. prices very much so not cooperating or not following the same trajectory. We, over the last couple of months, have seen domestic prices go from, depending on what index you use, 650 all the way to, let's call it 1050. So $400 move in the last 2 to 3 months. Pretty staggering move. You would think that would be surrounding a very big demand push, something booming in the economy. And I would say, at least in my opinion, that's not exactly what we're seeing. I would attribute a lot of this to a couple things. One is capacity utilization has been pretty subdued. I think some of that was purposeful. I think some of that's due to outages, maintenance, things like that is taking place over the last couple of months. Utilization rates are down at 74%, which is a pretty low number. So domestic mills are trying to keep a better balance in supply-demand conditions. Imports were fairly low for the last several months, at least up until about September, October. So that also helped to keep markets a little tighter than they otherwise would have been. And then I do think we saw a fairly large amount of domestic stockpiling or bottom fishing, however you want to word it, where domestic buyers of steel, those who have the capital to do so, went out and bought 5,000, 10,000, 20,000, maybe 50,000 tons of carbon sheet. And what that can do is it artificially, I usually use the word artificially, it is real, but it pushes out lead times to a very extended point. And I think when that happens, you get this perfect storm of domestic mills say, it's time to hike. It's hard to get metal right now. Let's take prices as high as we can. And that seems to be what they're doing. And I'm not trying to paint them in a bad light. I think that is That is a very, financially focused ideal, and a lot of these companies are publicly traded, and they're allowed to do so with their prerogative and balance supply-demand conditions. Do I think it's supported by the cost structure? No. If we look at power prices, natural gas prices, we look at scrap. If we take scrap prices for an electric arc furnace and we add on 250, we get this yellow line here, which basically says that the cost structure or the relative fair value of steel is somewhere right around $800 for hot roll. So if it's 800 for hot roll, maybe it's 1,000 for cold rolled. Well, the current price on domestic steel in the spot market is somewhere in the realm of $1,050 to $1,100. The futures market similarly is up around $1,100, at least for the next couple months. I wouldn't say any of this is supported by any, you may talk to a mill and they may say, well, scrap's gone up. Well, scrap hasn't gone up $400. They have an opportunity to make hay when they can, and I think they're certainly doing so. And if this feels familiar, it certainly should. This is the futures curve as of right now, or this week rather. So what we've got here on the futures curve is the peaking out somewhere in January 2024, at least if we took a snapshot as of today. That could change. If we get another round of price hikes, this could move higher and maybe it extends out into the future. But as we sit here today, the peak per the market's forecasting is January 2024. This curve looks an awfully like about 250 days ago when we saw prices dramatically run up. It was a situation where it was a very similar phenomenon. You couldn't get imports. You could barely access the spot market. If you wanted to access the spot market, it was name your price. And we saw that phenomenon take place over a couple months, and things peaked out in April 2023. So I don't want to say I'm predicting the future, but I would say that the setup for the steel industry looks eerily similar to what we saw in Q1, which transpired until the beginning of Q2, and then we saw things just kind of roll a bit lower as we rolled through the course of 2023. Already we're seeing this repeat. It's just kind of shifted back a couple months in terms of where the peak is being forecasted. So I thought that was a fairly interesting thing. The curves, you can tell where they bottom on the back end and where they peak on the front end, they're almost identical. And unfortunately, I personally just don't see, I think demand is fine. I think the end markets are mostly fine for steel, but I don't think there's anything that suggests that we should be seeing 90% volatility over the course of 3 or 4 months, or prices going higher by that amount over that period of time. So my gut is it may not look exactly like this futures market, but this could be something that's somewhat short-lived, unless we see something change in the demand side of the equation.
And
on the aluminum
sorry, before you get in there, Mark, maybe this is the best question for you. There's been a fairly significant amount of price increases announced from the mills in September too, right? Do we think that's going to continue into the new year?
It could. Nick put everything, pretty much like, I would have said it as well. Yeah, we've seen a rash of increases, that started at the end of September, and they've all made their way into the market. So yeah, could we see some more? It's possible. I think, once you get some, some scrap data that comes out, give the mills any kind of, reason or rationale to do it again. Yeah, I think it's certainly possible that you could see that.
And the price spread between, go ahead. Go for it.
I was just going to say, to add in real quickly, and I'm not saying this is a big risk factor, but it's something to at least consider. We talked about capacity utilization being down at 73, 74%. There is currently they're estimated 5 mills in the rumor mill to be potential purchasers of U.S. steel. I'm just throwing this out there. I don't think that this is necessarily how it happens, but if an entity were to take over U.S. steel and God forbid they decide to close down a bunch of those facilities, that could further tighten the market, and that would change my outlook on where we ultimately see steel prices go. But barring something very unique and specific like that, I would say I would expect if you're going to buy those assets, you intend to run them.
Yeah, agreed.
But I apologize, Mike. What were you going to ask?
No, I think you hit on the U.S. steel. So we're good.
Okay, excellent. Yeah, Mark, are there any latest rumors or discussions around who may be the front runners on that?
No, not really. There's been a lot of, I mean, a lot of rumors as to who could be the winner of that. But no, we keep hearing dates that have come and gone for this acquisition to close. But no, nothing's transpired as of yet.
Okay. So flipping over to the aluminum side, I don't want to put words in Jeff's mouth, but I will say the aluminum industry, or at least the aluminum commodity portion, has been fairly boring over the last couple of months. He may disagree with me because he's a big fan of aluminum, a big proponent of the industry. But when you look at the price over the last probably 18 months, it really hasn't moved a whole lot. I mean, there have been some small blips higher, but for the most part, I drew in this white support line. I still think that area, right in the mid 90-cent range for the LME, is continuing to act as good support. It looks like that's an area where the higher cost aluminum producers, they do get challenged on being able to make money at those types of price levels. So for now, that support level in the mid 90-cent range is holding up. I think on the last call, I was noting the fact that we were beginning to see a little bit of optimism in aluminum. I think what threw a little bit of cold water on that was about a week ago, or maybe within the last week. Moody's, which is a ratings agency, they downgraded China's credit rating as a country from neutral to negative, which may not sound like a whole lot, but that's a pretty meaningful thing when you think about cost of financing for an economy, and just overall investment perception into a country as large as China. And for those who are new to commodities, I mean, China makes up 50 to 60% of the overall aluminum demand picture. So if they are viewed in a negative light, that certainly feeds into things like aluminum, or really commodities in general. And I didn't mention this earlier, but you look at the Bloomberg Commodity Spot Index, which, Mike, maybe we could put something together for one of the marketing documents. The Bloomberg Commodity Index, which is a basket of everything across crude oil, natural gas, agricultural products, and metals, it actually hit the lowest level since, I want to say, August of 2021. So when we think about inflation, deflation, we're certainly seeing commodity prices taking on the chin at the moment. And similarly, in addition to the LME, the Midwest premium has been wildly boring and flat. So I'm not even going to spend a whole lot of time on it, but it's basically either side of 20 cents. But that being said, I do want to give Jeff a chance to talk about anything that he's finding very interesting within the aluminum space.
How do I fight that? You called it boring.
Boring is the opposite of risk, is his title. So
yeah. If you look at the chart, we went through a pretty tumultuous time frame there for a period. I mean, even just looking at history wise. I mean, what, in the last year and a half, or a little over a year and a half, we've seen LME drop 80 cents. That's a pretty significant drop.
And it is a totally fair point. Maybe something we should spend a second on, which is these types of price moves in aluminum over the course of the year, 10, 20%, that's a more normalized LME move over the course of the year. What we saw in 2020 through 2022 was not normal. So yeah, fair point that relative to what we've been through, it feels boring, but I like the action. I like the action, Jeff.
Yeah, no, it's good. I'm sitting flat for a period of time. Boring sometimes isn't bad either.
You're right. You're right.
I mean, the audience doesn't think aluminum is boring, Jeff. They're throwing in a few questions here. There's a report group noting an aluminum supply surplus in 2024 and an outlook. Are you hearing that about a supply surplus in 2024 for aluminum?
It depends on what the product is. Certainly, we're seeing some relative softness and availability in the soft alloy extrusion side of things, and I think we see it on the common alloy side as well. I think the one outlier, on the heat treat side, when you get into, what could be an uptick in the semiconductor market, and then there's a lot of optimism around aerospace. That product might see some tightness in 2024.
That was actually what I was going to bring up, Jeff, was we are seeing aerospace and just deliveries of airplanes be really, really strong at the moment. With regards to the grades, a shame on me for not knowing this off the top of my head. Is that 6000 series aluminum? What grades would that be?
Predominantly 2 and 7.
2 and 7? Okay.
The bulk of it would be in, the 7 series.
Okay. Yeah, so those would be products you would expect to be a bit more incrementally tight.
That's right. Yeah, and again, those are all under the family of the heat treat products.
Cool. Looking very quickly at where money managers are positioned, you can kind of see what we talked about anecdotally, which is from September through beginning of November, traders actually were positioning themselves in a slightly more bullish fashion. So anything above zero is net long positioning or bullish positioning within LME. Anything below zero is bearish, where they're net short the product. And you can almost see it just directly in this chart. When the news was released that China was getting downgraded, you can kind of see the air came out of the tires, and a lot of money managers basically said, I'm bailing on this product, or maybe even they're going short on the product. So, this does tend to have an influence, maybe not the entire influence, but it tends to have an impact on where commodity prices go. No,
sorry.
I guess. Yeah.
Sorry, Nick. One more thing on aluminum. Are there any thoughts, Jeff, on the aluminum extrusion anti-dumping case? Kind of what's the latest there? What's the latest going on
I
there?
think there's a strong anticipation that something is going to be implemented, and it will have an impact on what imported extrusions we're going to be able to get your hands on. So yeah, that's in the works, and we think it in some form or fashion, it's going to be in play.
You think they'll make a decision on that anytime in the near future?
I don't know if I can put a timeline on it, but it feels short term.
Gotcha.
I would say it's going to be sooner.
Yep.
But that's my take on it.
Oh, good.
Flipping over to the nickel side of things, it really is a continuation of what we've been seeing the last several months, which is more supply is ramping up, mostly out of Indonesia. And as that supply is ramping up, it's just creating bigger and bigger surpluses over the course, and we expect this to continue over the course of the next 12 months or so. And it's no minor amount that's coming online. I've seen numbers cited as large as about 25 to 30% of the global nickel market is being added over the last 6 months and the next 12 months. So it's a fairly meaningful amount. The only thing that really jumps out to me as being something that would stop this slide would be if Indonesia comes out and says, we're going to slow these ramp ups in mining activity. Barring something like that, we see continued pressure in the price of nickel, and what that means for stainless is it would result in decreased stainless steel surcharges. So more of the same is what we're seeing. And I think just on a month over month basis, we're down another 10% versus where we were even last month, which was already under pressure. And you can see that pretty evidently here within the commitment of traders report, which is showing that for the better part of the year, traders have been positioning more and more bearish, or said a different way, more and more short, which means they're expecting the price to come down. So there's some small blips higher. Maybe there's small news events that can cause an intraday a short squeeze or something like that. But for the most part, the fundamentals seem to support a well-supplied nickel market. And then lastly, I want to note on the copper side, we don't normally cover copper, but I did want to note a couple weeks ago, a Canadian miner called First Quantum, they have a copper mine down in Panama, and pretty big news. About 2 weeks ago, it was ruled by their government that it was unconstitutional for them to continue operating that mine. And worth noting, that mine is equivalent to about 1% of the world's supply of nickel. So it essentially got knocked offline just due to legal reasons. I'm sure there's going to be a multi-year legal battle around it, but it doesn't look like a whole lot. But you've seen over the last couple of weeks, momentum to the upside has picked up a little bit in the price of copper. So something to keep an eye on there, because that was a market that was already somewhat tight as a lot of different global economies move more and more towards greenification, technological solutions, things like that. With that, nice. We've got Mark Gross and Jeff Notice, and I guess myself on the hot seat because we're all experts.
Yes.
Apparently.
And, yeah, absolutely. Yeah. I asked internally, I said, give me the experts, the ones who know everything, and
the best of the best.
They didn't answer the call. So Jeff,
yeah, they weren't available, so you got us.
So let's have a little bit of fun, and I say to the audience, there's no bad questions here. Throw it out. Something you may have always wanted to know, something you want to stump these guys with. I'll start. Let's talk about the mills, and Mark, this one's for you. I hear a lot of times something called an integrated mill and a mini mill. What are they talking about?
Yeah, so the simplest way to put that is the main difference is the raw materials used. Integrated mill used mined iron iron ore and coal, whereas mini mills, you scrap steel, and that's, basically from recycled automobiles, equipment, or, any byproduct of manufacturing. Integrated steel is basically making it from scratch, and you can look at mini mills as more of a recycling process. So it's pretty easy one.
Why do they call it a mini mill?
Maybe because, at the time they probably couldn't offer the same breadth of products as an integrated mill would be my guess on that.
Okay. All right. I'll keep you on the hot seat there and ask you to explain the difference between hot rolled and cold rolled.
All right. Okay, so we'll start with hot roll. Basically it's just a mill process. Involves producing steel at high temperatures. Say over 17,000 degrees Fahrenheit, and it's cooled to room temperature, tested, and ready to ship out. Where this cold roll, you take that hot roll steel, then you process it further. Annealing, temper rolling, and that's why it's more expensive than hot roll. Now the main difference is that cold roll steel is used for more precise applications than hot roll. You think of hot roll using for more larger structural components, beams, columns, frames, and think of cold roll used for smaller, more precise components, brackets, screws, bolts. And the two products feel differently as well. Hot roll's more scaly, dry finish, or cold roll's typically kind of a smooth, oilier surface.
Okay.
That's detailed.
Yeah.
How about
absolutely.
that? Yeah.
Yeah. Mark's one of our speakers on our Metal 101, so he's got the basics down. Jeff, maybe we'll put this over to you. At what threshold does sheet become plate? We talk about sheet becoming plate. What's the threshold there?
Yeah, on the aluminum side, the general rule is going to be 249. Anything that's 249 or below is going to be a sheet product. Anything that's 250 and above, we define as a plate product. But I would add, we do have the ability to buy coil up to 0.375 thick material. So there are some anomalies that come into play, but as a general rule, 0.249 and below, and then 0.250 and above is plate.
Okay.
Which is a little bit different than I think you get on the stainless side and in other products.
And then Jeff, would there be specific mills that would produce one type versus the other, or is it more common to see mills are able to produce the entire swath of everything up from sheet to plate?
Yeah, when you get into the plate side of it, there's going to be less providers. When you get on the non-heat treat side, the 3003, the 5052, common alloy type of products, there's going to be more suppliers. And I say that more from a domestic standpoint. Obviously, you start getting the imports, and then it gets a little bit more clouded, but certainly domestically, more providers of the sheeted product exist versus plate product that is out there. And most of the plate that we would entertain, a lot of those would fall under the alloys of a 2, a 6, or a 7 alloy. Whereas the sheet product, a lot of that's going to be your 1, 3, and 5 series alloys.
We got a question from the audience. What's the main difference between pipe and tube for stainless?
Well, I think that would apply for any product, actually.
Yeah.
Yeah. I mean, you're talking OD, ID versus a thickness. That's the variance that, in my general knowledge, as it relates to tubing and pipe.
And OEIU would be inside,
yes,
inside and outside diameter.
And then you get into pipe, you get into Schedule 40, the Schedule 80, and that's going to be the thickness of what that pipe is going to be.
Okay. I heard it explained one time, very simplistic to me, that pipe holds things up and tube holds things in. So that's good. Or I'm sorry, the other way around. Tube holds stuff up, and pipe holds stuff in. So see, I don't understand.
Next question. He just wanted to throw the answer.
Nick, I think you have one for the group, right?
Yeah. So I was watching the Cybertruck presentation, and they decided to get out a Tommy gun and I think it's like a 9mm Glock and start shooting the vehicle. And I was wondering, what is the threshold to make a stainless steel vehicle bulletproof?
You want to answer that one, Mark? I'm gonna fall on the sword and say I watched the video, so I know what they claim is bulletproof, and in the Cybertruck they claim 1.8 millimeter stainless. The 300 series, they don't define it by what 300 series. So 070 thick stainless is going to stop that the Tommy gun or the 9mm Luger. So
Now, did you watch the video because you have a reservation for the truck?
did I what?
Did you watch the video because you have a reservation for the truck?
Well, not just one. I got two. I picked up two of them. I got two on them.
Love it.
Nick, someone in the audience has one for you. Is there any index you'd suggest to follow to track U.S. carbon wire pricing?
Ooh. Carbon wire. I mean, if I'm doing that, if I'm asked that question, I'm likely going to Fast Markets, which is the new version of AMM. They usually have a fairly deep array of long products and wire products on there.
Yeah, agreed.
Okay. How
And yeah, I
about,
guess if we have any salespeople or customers that want any information on that, I'd be happy to dig some up for them.
gotcha. Someone's asking how many different types of tempers exist in aluminum, and what are they?
Well, the major ones that we would deal with, there's three of them, and really there's two. There's, we talk sheet and you talk plate. That's the H and the T temper. So H is a strain hardened. That's going to be your sheet type of product. T is going to be your thermally treated. Those, add strength to the product. Those are the ones I mentioned earlier that are plate. And then you see a lot of O, which is annealed, also called dead soft. Those are the three majors, but there's five in total. You do get some as fabricated or an F designation, and there's a W that exists as well. But through my years of selling aluminum, going up on just over 25 years, a handful of times I've sold an F temper, and I can't tell you one time where a W temper has come up. So in total, 5 tempers would exist.
Hey, Jeff, I've got a question for you. A really random one, but
That's a
do
turkey.
you have a name for those turkeys that are walking behind you?
I was gonna say, I see something behind Jeff.
The one's named Mike, the one is Nick, and Mark should be coming here anytime.
Do you shoot at the one named Nick?
Yeah.
There's a question about the difference between U.S. and Canadian prices. I guess that's all it is. I guess, is there a difference when you're pricing the metal between U.S. and Canadian prices?
I'll jump in slightly, but they may be able to add more color on this. I mean, if you think about it in terms of aluminum ingot, yes, there's definitely a difference because within aluminum ingot, the idea of this Midwest premium, it is inherently a U.S. phenomenon, that it's meant to be the cost to getting aluminum ingot into the Midwestern portion of the United States. So because of that definition, up in Canada, they don't have that Midwest premium. So that would be omitted from the cost. That's one big example. I guess more broadly, I would say, due to protectionism, and this would be across all products, due to protectionism, I would view Canada and Mexico both as slightly different market dynamics. They have slightly different market dynamics, and as such, they have the potential to have much greater import penetration. And imports typically aren't coming in unless they're discounted. So I would say there is a little bit of a dampening effect on both in Canada and Mexico pricing.
Anything anybody else wants to add?
No, I was going to mention, I mean, what he mentioned on aluminum is spot on. And certainly in the US, we see the variance from import to domestic with the LME versus the Midwest ingot. But keep in mind, a lot of the import product coming in with anti-dumping and countervailing duties and tariffs that are coming into play.
Yeah, same thing on carbon. Nick hit it well. I mean, they're two different markets, and a lot of it's driven by the import.
Sounds. Nick, we got one in here from your analyst Kevin. He wants to chime in and he wants to stump you. So this is very specific. So if you know these answers, I mean, more power to you. In June of 1981, Paul Volcker, the then chairman of the Fed, raised rates what percentage to try to tame inflation? So this is a two-part question. I guess what was the inflation rate at the time, and by what percentage did he raise it in 1981? This sounds like a very specific thing. Maybe you
It's
guys
a tough
talked
one,
about
but,
before.
yeah, as a history lesson, Paul Volcker is the one who effectively just kept hiking and hiking and hiking until he just destroyed the economy. But I would say he did so purposefully. There are questions about whether Jay Powell is the reincarnation of Paul Volcker or not. But in terms of the actual values, I don't know, but I'll make a guess. I would guess that inflation was 13%, and he took interest rates to 18%.
Rates were 14.8% and raised it and he took it to 20.
Oof.
I think that's a passing grade.
Yeah. Hey, that's
a B plus.
got in the curve. That's good. Yeah.
Thanks a lot, Kevin.
Very specific. Everyone else got the softballs. There you go. We're getting a lot of general questions just on what do you guys think, Mark and Jeff in particular, what markets you think are really hot as we kind of enter into the new year? I mean, you mentioned aerospace, Jeff. A few mentions here about the wind market. So do you see that as a big market? I guess if you were to kind of characterize the market going into next year, what are some of the hot ones you guys are keeping an eye on?
So, you mentioned wind. That's been a big one for, offshore wind towers. That's been a big one for carbon plate, for mainly this year. And I think the outlook for next year looks equally strong. On the sheet side, auto kind of drives the bus, historically, and that's probably going to be no different next year, as we're coming off the resolution of the UAW strike.
Yeah, the big one for me on the aluminum side is going to be aerospace. But I've heard rumblings, oddly enough, which somewhat surprises me, that we're seeing some uptick in activity in building construction, which, I hope it lasts. But I would have anticipated with where interest rates are at and everything you hear on the housing side of things, more on the residential, that would not have been as good. But we're hearing some good remarks on it, at least early part of 2020.
In addition to that, broadly, I would probably say data center industry seems to be running very strong still. A lot of that's related to cloud computing, AI, those themes. And then the renewable trends are still trending pretty well at the moment. Those are the hot ones. On the cool side, I don't want to be too much of a wet blanket, but we are seeing like farm equipment data tracking somewhat weak relative to a lot of other industries.
And there's been multiple questions about imports. What is any reason why steel imports are down is one specific question, I guess. Are they, and any reasons where we see that to be the case?
Yeah, I mean, on the steel side, I mean, for most of the year, just haven't been as competitive. We haven't seen a lot of competitive offers. Tariffs are still a thing as well. So now this recent price resurgence on the domestic side, yeah, I mean, this thing could probably pull some imports back in, but that's kind of what we've been seeing for the majority of this year.
Yeah, I mean, think about it, over the course of 2023, it was basically a scenario where prices were going down, down, down every single month. And if that's the theme, it doesn't make sense for somebody like us or an end user to go out and buy something that has a 5 or 6 month lead time when it's probably going to be way, way overpriced by the time it gets here. And as an example, I mean, back 2 months ago when we were seeing domestic steel prices down around $650, imports were $850, $900. They were not attractive at all. They were actually very unattractive. So I think that would be the main explanation for why we, at least at that time, hadn't seen them pick up. My gut kind of says, now that we have domestic prices at 1,100, I think that math works a whole lot better.
Yeah, absolutely.
I put Nick on the spot, so I'm going to put you guys on the spot with each one too. So, Jeff, for you, do you know when was aluminum discovered and by who?
Do I have a range of?
Yeah, absolutely. Yes, yeah. 2 years, either way.
Well, it was in the 1800s. Am I good on the? Do you narrow it down even further?
Getting warm.
I think
you're in the right century. You're in the right century.
Yeah, I want to say the 1880-ish range. When things got started to pick up speed on it.
I have 1825
I think that's when they discovered it was back then, but I think when they started actually doing some production more was in the latter part of the 1800s.
Look at him trying to hedge his bets.
I'll give it to you. I'll give it to you.
Be on the net.
Good one. All right. You guys know your stuff. How about Mark? Do you know the process of making steel that Andrew Carnegie originated?
Wow. Yeah, I don't think anybody's accused me of, being a real steel historian. But I think that one was the Bessemer process.
That's right.
Nailed it.
You're right. You're right.
All right.
I'm trying to look at your guys' eyes, see if you're Googling as I'm asking these questions.
I can't work the Google machine that fast, unfortunately.
Well, yeah, you guys know your stuff. All right. Nick, this one's probably for you. Do you think the NCAA handled the suspension of Jim Harbaugh correctly? And do you think any foul play was there?
I don't think the finality of that is complete. I think there will be more to the story, but yeah, I just wish we would have won. That stank.
Yeah. Well, it's been fun. Thanks for getting on the hot seat, everybody. This is the point in time. Give some closing thoughts. So I'd love it, Jeff, Mark, if you guys just kind of, give some wrap thoughts for what you're thinking, kind of closing thoughts. Nick, over to you, and maybe start with Jeff.
Mine will be short. I'll just say happy holidays to everyone. It's been a great 2023 and looking forward to what 2024 brings.
Thank you, Mark.
Yeah, I mean, I'll echo those sentiments as well. Thanks for you guys for taking for giving me this opportunity, and yeah, happy holidays to you and your family.
Before you go in, I mean, I should note we have these guests throughout the year, Jeff, Mark, and it just a range of folks that come in, and they know their stuff, and I mean, it's always a fun discussion, and we do appreciate you coming on, and really taking some time and helping educate the audience. So thank you for that.
Yeah. Well, thank you, Mike.
Yeah, absolutely.
Mike, is this the last cup of Joe we have till before Engage?
Oh, we will have the one in January. We'll have January 4th, the first Thursday in January.
Excellent. Yeah, I guess I would just say it certainly feels like we're in new times over the last 6 to 12 months relative to what we saw in 21, 2022. Some of that's going to be good news. Some of that's going to be more difficult news. But yeah, I think the markets are very confusing right now. The economy is very confusing. It's in a very confusing place right now. But we hope everybody's enjoying the information we're sharing. And if there are any Florida State Seminole fans out there, thoughts and prayers for all of you for not making the playoffs. I think you got hosed. I don't understand that one. And to everybody else, happy holidays and have a happy and safe one.
Happy holidays, everyone. Thanks.